Welcome back to 3-Star. And today's explainer, we're diving deep into advanced market structure. We are going to completely shift your focus from just chasing random green candles to actually seeing exactly who is manipulating the market behind the scenes. Let's get right into it. Look, we all know the pain, right? You spot what looks like a totally clean momentum setup, you confidently hit buy, and then bam. The market immediately snaps back and stops you out. You're just left sitting there, staring at your screen, realizing your stop loss just became the market's liquidity fuel. Section 1. The Fake-Out Trap. Stop chasing candles. Moving into Section 2, CHoCH, the early warning. So a change of character, or CHoCH for short, is not a guaranteed reversal. You've got to remember that. What it actually is your critical first alert that control is slipping away from the dominant players. But here's the advanced secret you need to internalize. A valid CHoCH requires a candle body close. If you just see a wick pushing past a level, that's not a structural shift. That is a liquidity trap designed to catch retail traders completely off guard. Let's break down the actual mechanics of this shift. A bullish CHoCH happens when the price has been in a downtrend, but instead of making another lower low like you'd expect, it suddenly breaks right above the previous lower high. Basically, sellers are losing their grip. On the flip side, a bearish CHoCH happens in an uptrend when a higher high snaps back aggressively below the previous higher low. When that happens, the entire character of the market has officially flipped. Section 3. The SOAS, the structural proof. Now, if a CHoCH is a reversal warning, a break of structure, or BoS, is your pure trend continuation. It happens when the price makes definitive new highs or lows. That is your proof that the new participants have actually taken the wheel. A bearish BoS is cold, hard confirmation that sellers are now driving, while a bullish BoS is undeniable proof that buyers are pushing for those new highs. So you really need to drill this sequence into your head. The CHoCH, that's your early warning. The BoS, that's your undeniable proof. When you start seeing these two working together, you're no longer flying blind or just guessing at tops and bottoms. You are reading the structural shift in real time as it happens. Section 4. Waiting for the pullback. The real setup. All right, here is exactly where most traders get absolutely slaughtered. They see a structure break, the FOMO completely takes over, and they enter right then and there. But listen, the market needs fuel. It needs inducement. Price has to pull back to trap those early buyers or sellers before the real sustained move can actually take off. So the question becomes, where does price actually pull back to? Well, the secret lies in identifying the imbalance, specifically the fair value gap. Your job as a trader is absolutely not to jump in at the initial break. Your job is to wait patiently for the price to retrace into the specific area of institutional imbalance. You have to let the market come to your zone. Let's look at how this builds into a complete mechanical entry blueprint that takes emotion entirely out of the equation. Step 1, you spot the CHoCH warning. Step 2, you patiently wait for that pullback right into a fair value gap. And step 3, you confirm the move with a clean break of structure. You're not sitting there hoping for a reversal. You're waiting for the market to provide mathematical proof. Section 5. Automating the setup. The price action toolkit. Now, tracking all of this minor and major structure manually, it requires intense, exhausting focus. But as our source highlights, there are tools like the Price Action Toolkit that can automate this completely. It marks out those real-time CHoCH and BoS signals, maps inversion fair value gaps, and importantly, it draws premium and discount zones. This means you instantly know to only look for shorts when price pushes up into a premium zone above 50% and only look for longs in a discount zone below 50%. It essentially hands you a map of exactly where the highest probability reactions are going to happen. By locking down these structural sequences, you completely eliminate that emotional guesswork we all struggle with. A CHoCH warns you, a fair value gap gives you the prime location, and a BoS confirms your entry. You finally get to step out of the dark and trade with genuine professional context. So the very next time you feel that overwhelming urge to chase a massive green candle, stop and ask yourself, are you reading the market's true structure, or are you just becoming liquidity for the institutions who are? Stop chasing, let the price come to you, and start trading the shift. If this explainer added value to your trading journey, make sure to subscribe to 3-Star and let us know in the comments, what was your biggest aha moment today? See you next time.